Imagine pulling off like a really fantastic quarter for your business.
Right.
You boost your sales, you lock in this massive, what is it, $338 million pipeline of future work.
Yeah, a huge pipeline.
But somehow you end up losing almost 5 times as much money as you did this exact same time last year.
Oh, man. Yeah.
That is the exact mathematical paradox that DIRTT Environmental Solutions just reported in their Q1 2026 earnings release, which dropped yesterday, May 6th.
It's a phenomenal contradiction on paper, really. You have this top-line growth actively colliding with, well, a pretty harsh bottom-line deterioration.
Right, exactly. So welcome to today's deep dive. We are taking a magnifying glass to this, and it is an incredibly dense data drop setting the stage for DIRTT's earnings call happening later today.
Yeah, we should probably explain DIRTT for a second.
Yeah, please. Because it stands for doing it right this time right.
Exactly. Doing it right this time. And if you aren't familiar with them, they are a massive player in the industrialized construction space. They build these highly adaptable, modular interior environments.
Okay, so what does that actually look like?
Think about a modern hospital or, giant tech headquarters. If a hospital needs to rewire an entire ICU over a weekend.
Which is a nightmare.
Right, an absolute nightmare.
Right.
Or if a tech company needs to reconfigure a whole floor of offices, you cannot do that with traditional drywall, 2x4s, and plaster.
Yeah, that takes months.
Exactly. It takes too long, generates too much waste. So DIRTT manufactures these cutting-edge, snap-together architectural walls, and they have the technology and plumbing pre-integrated into them.
Oh, wow.
Yeah, which allows spaces to be, instantly scalable.
So no drywall dust, no massive construction delays, just clean, scalable interiors. I love that.
It's brilliant.
But today's deep dive, it isn't just a breakdown of how they build walls. I mean, this Q1 report is honestly a real-time case study.
Oh, 100%.
It's about a company navigating this wild collision of global supply chain chaos, intense corporate drama, and a massive structural turnaround.
Yeah, an earnings report is essentially like a house's blueprint. It might look really pristine and solid on paper.
Right.
But you have to look really, really closely to see where the foundation is actually reinforced and where the pipes are leaking.
Oh, that's a great way to put it. So let's start with the front door of the business, right? That revenue paradox I mentioned at the top.
Yeah, the headline numbers, they look totally fine if you only read the first sentence.
Right.
I mean, Q1 2026 revenue came in at $42.4 million.
Which is good.
Yeah, that's a solid 3% increase from the first quarter of 2025. They're moving more product. They're generating more gross revenue.
Okay, let's unpack this because that 3% bump is where the celebration aggressively stops, doesn't it?
Pretty much, yeah.
While revenue went up, their net loss after tax deepened significantly. I mean, they posted a $3.3 million net loss this quarter.
Yeah.
And a year ago, that loss was only $0.7 million. Plus, their gross profit margins shrank from 35.2% down to 30.6%.
It's a huge hit.
I'm looking at these numbers, and I have to ask, how do you increase revenue but bleed that much more cash? It's like getting a 3% raise at work, but your rent and groceries went up so much that you're actually poorer at the end of the month.
That is honestly, that macroeconomic squeeze is the defining story of this quarter.
Yeah.
What's fascinating here is how quickly that volatility eats into everything. When you dig into the cost of goods sold in this report, you find the primary culprit dragging those margins down.
It is?
The skyrocketing cost of raw aluminum.
Okay, wait, why aluminum specifically? Could they not just pivot to steel or, I don't know, engineered wood to cut costs?
No, because aluminum is the absolute lifeblood of modular construction.
Really?
Yeah. It's lightweight, which keeps shipping and freight costs down. And more importantly, it can be extruded into incredibly precise, complex shapes.
Oh, because everything has to snap together.
Exactly. When you have walls that need to snap together seamlessly without tools, right on a job site, you need millimeter-level precision. Aluminum provides that.
Makes sense.
So when global aluminum prices surge, and when heavy tariffs are suddenly applied to those imports, DIRTT's manufacturing costs just instantly skyrocket.
Wow.
Add in the fact that they saw lower margins on some of their heavier installation projects this quarter, and the top-line revenue growth gets entirely eaten up by just the cost to deliver the product.
So the foundation of their product just became exponentially more expensive overnight.
Exactly.
But there is another major line item dragging down that bottom line: Reorganization costs.
Oh, yes.
Those went from a modest like $200,000 in Q1 of last year to a staggering $2.4 million this quarter.
It's a massive jump.
What exactly are they buying for $2.5 million of reorganization?
Well, the report attributes that spike directly to termination benefits and consultant costs.
Ouch.
Yeah. Last year, their reorganization expenses were purely logistical. They were physically moving inventory and equipment out of a facility in Rock Hill, South Carolina, back to their Calgary headquarters.
Okay, so trucks and movers.
Right. But this year, the cost is entirely personnel and strategy. They are paying out severance packages and hiring outside consultants to execute this massive structural transformation.
So they are essentially burning cash right now to trim the corporate fat and like figure out a new operational playbook.
It is the painful, expensive process of turning a very large ship. They are stripping down the management layers to build a leaner operation capable of surviving these exact macroeconomic shocks.
Which I guess brings us to how DIRTT is actively fighting back against these pressures. Because they aren't just letting global aluminum markets dictate whether they survive, right?
No, not at all.
They are launching a counteroffensive. The report highlights a 1% tariff surcharge applied to all orders placed after March 18th, 2026.
Right, and passing that cost directly to the consumer is a rapid tourniquet. It stops the immediate bleeding from the aluminum tariffs.
Okay, here's where it gets really interesting. Is a 1% surcharge just a Band-Aid on a bullet wound? Or is there more to it? Like, does that actually solve the structural problem, or does it just annoy the end customer?
A 1% surcharge is definitely a Band-Aid. It's purely defensive. But, and this is crucial, the report outlines an early 2025 tariff response that has now been fully embedded into their operating model.
Oh, okay.
Yeah, they took a crisis and weaponized it into a competitive advantage by engineering cross-border manufacturing flexibility.
Okay, what does cross-border flexibility actually look like on a Tuesday afternoon on the factory floor?
Think of it like driving a hybrid car. If gas prices skyrocket in your city, you don't panic. You just flip the switch and run on the electric battery.
Oh, I like that.
DIRTT is based in Calgary, Alberta, but they operate all across North America. They have structured their manufacturing lines and their software so that they can seamlessly shift production volume between Canada and the U.S.
Wait, really?
Yeah, if U.S. tariffs on raw materials suddenly spike, they just route the manufacturing through their Canadian facilities.
So they are playing geographic arbitrage in real time.
Exactly, and it pays off beautifully. For example, the Canadian dollar weakened relative to the U.S. dollar this quarter.
Right.
Because they can shift capital and production across that border, that currency fluctuation actually netted them a $C.3 million foreign exchange gain.
Wow.
Yeah, most competitors in the industrialized construction space are entirely static. If a tariff hits their single manufacturing hub, they just have to eat the cost. DIRTT's ability to dynamically shift where a wall is built based on that morning's global trade winds is an immense economic moat.
That shifts the narrative completely. They aren't just reacting to the supply chain. They have built a machine that can dodge the roadblocks entirely.
Exactly.
But dodging supply chain issues is only half the battle. We have to talk about the corporate drama inside the house.
Oh boy.
Because reading the legal and personnel sections of this earnings report feels a bit like a corporate thriller.
The activity in the boardroom and the courtroom is moving just as fast as the factory floor right now.
Let's start with the lawsuit. On February 2nd, 2026, DIRTT commenced a massive 10-week trial. 10 weeks.
Yep, in the Court of King's Bench of Alberta.
They are suing a rival company called Falkbuilt Ltd., but more importantly, they're suing several former DIRTT employees, specifically naming Mogen Smed and Barry Loberg.
The allegations are severe too. DIRTT is suing for breaches of fiduciary duties, breaches of confidentiality, and violations of restrictive covenants.
Wow.
And they're seeking damages across Canada, the U.S., and internationally. The trial has dates reserved all the way into July of this year.
Let's translate some of that legalese for a second. What exactly does a breach of fiduciary duty or a restrictive covenant mean in this context?
So, a fiduciary duty essentially means that while you are employed by a company, you have a legal obligation to act in its best financial interest.
Right.
Not, secretly sabotage it or funnel its resources elsewhere.
Right, of course.
And restrictive covenants are usually your non-compete or non-solicitation agreements. It's a contract saying you won't leave the company and immediately steal its client list or proprietary methods.
But a 10-week trial is incredibly expensive and distracting for an executive team. Why is DIRTT willing to burn that kind of time and capital in court?
Because in industrialized construction, the physical wall isn't the real product.
It's not.
No, the real product is the proprietary software, the 3D rendering technology, the highly specialized manufacturing processes that actually tell the machines how to cut the aluminum.
Oh, I see.
That intellectual property is their entire valuation. Defending it aggressively isn't optional. It's existential.
And while this legal war is happening, the executive team itself is undergoing a major shuffle.
Yeah, a lot of movement.
On January 12th, President and Chief Operating Officer Richard Hunter departed the company. And on that exact same day, Aaron Merkin joined as the new Chief Technology Officer.
Which is huge. Bringing in a CTO to replace a traditional COO role signals a massive pivot.
How so?
It suggests DIRTT is leaning heavily into the software and digital ecosystem side of their business, rather than just traditional manufacturing operations.
Okay, that makes sense. And their finance team was equally busy doing gymnastics.
They really were.
They secured a $10 million cash injection, which is about $6.9 million US from the Business Development Bank of Canada, or BDC. And they immediately used that cash to repay $16.6 million of their January debentures.
Right.
Quick detour for our listeners who haven't navigated corporate debt structures recently. What exactly is a debenture and why pay it off early?
A debenture is essentially an unsecured corporate bond.
Okay.
It's a loan backed only by the company's general reputation and creditworthiness, not by any physical collateral like a factory or equipment.
So it's risky for the lender.
Extremely. Because it's riskier, debentures usually carry really heavy interest rates. So using a fresh injection of capital from the BDC to wipe out $16.6 million of that unsecured debt cleans up their balance sheet significantly.
Right.
It reduces their ongoing interest burden.
And couple that with the fact that they formally negotiated an early exit from a facility lease in Rock Hill, South Carolina, and you see a finance team just aggressively stopping cash leaks.
Exactly.
That leaves one final piece of the corporate drama puzzle, the activist investors. On February 13th, DIRTT signed a support agreement with the 22NW Fund, their largest shareholder, and the 726 entities. Together, these groups hold about 15% of the company's shares.
And the critical element of that agreement is the standstill provision.
Okay, what does that mean?
Well, they secured voting obligations from these investors for the 2026 annual meeting, and in exchange, they added Jeremy Gold to the board of directors.
So what does this all mean? Like, why does a standstill agreement matter so much right now? It sounds like a captain trying to steer a ship through a storm while simultaneously dealing with a mutiny and a newly negotiated peace treaty with the ship's financiers.
That's spot on. And this raises an important question. Can management maintain focus?
Right.
A standstill agreement buys management the ultimate luxury breathing room.
Yeah.
When you have activist investors holding 15% of your company, you are constantly at risk of proxy battles, hostile board takeovers, and just endless demands to justify your daily decisions.
Sounds exhausting.
It is.
Yeah.
A standstill agreement is a formal truce. It guarantees the investors won't launch a coup this year, which allows the executive team to actually focus on selling products and executing this turnaround plan.
Instead of constantly looking over their shoulders.
Exactly.
They finally have a clear runway. Which brings us to the blueprint for the rest of 2026. With the courtroom battles actively being fought, the balance sheet cleaned up, and the boardroom truces signed, what does the future actually look like?
Well, the forward-looking indicators are incredibly robust.
Yeah.
Their 12-month forward-looking pipeline, which tracks all the potential projects they are actively pursuing, sits at $338 million.
That's massive.
It is. That is a 16% jump compared to where they were at this time last year.
And the composition of that $338 million is really intriguing to me. The report highlights that about $55 million of that pipeline is coming from a specific channel called construction services.
Yes.
Why is the company calling out construction services as a separate major victory?
Because traditional modular sales can be unpredictable. You sell the walls for a project, you install them, and then you have to go hunt for the next one-off project.
Right. Starting from zero every time.
Exactly. The construction services channel is different.
Yeah.
These are engagements usually governed by broader, ongoing contractual arrangements.
So it's the difference between selling a single physical CD versus getting someone to sign up for a monthly Spotify subscription.
That is an excellent way to conceptualize it, yeah. Construction services provides recurring, highly visible, contract-based revenue. It smooths out the chaotic boom and bust cycle of traditional construction timelines.
That's huge for stability.
Huge. And because they have secured this pipeline, DIRTT is confidently maintaining its full-year 2026 guidance. They are projecting between $194.0 and $209.0 million in total revenue for the year.
Wow. And they are projecting 26.0 to $31.0 million in adjusted EBITDA.
Right?
For anyone not living in financial spreadsheets all day, adjusted EBITDA is essentially a measure of a company's pure operational profitability. It's the cash they make before you factor in taxes, interest on debt, or massive one-time expenses like that $2.4 million reorganization cost we talked about.
Exactly. It strips away the accounting noise to show you if the core business model is actually making money.
Right.
And DIRTT was very specific of how they arrived at these projections. The press release explicitly notes that this financial guidance fully incorporates the impact of tariffs, as well as the recent spikes in raw material and oil prices tied directly to geopolitical development.
Right, and they specifically name the Iran war in their report.
Yes, they do.
And just to be super clear for everyone listening, we are impartially reporting the contents of this earnings guidance. We aren't taking any political sides here or endorsing any viewpoints on the conflict itself.
Right, absolutely. The source just cites this geopolitical conflict strictly as a macroeconomic factor influencing their oil and raw material costs.
Exactly. We're just looking at the economic math they're presenting.
Right. From a purely supply chain perspective, DIRTT is factoring that global instability directly into their bottom line.
They are pricing in the chaos.
They are. And if we connect this to the bigger picture, hitting $194 million to $209 million for the year is a massive climb from the $42.4 million they just reported in Q1.
Yeah, how do they get there?
Well, Q1 is historically their weakest quarter. The winter months always slow down commercial construction.
Oh, true. So you combine the seasonal spring thaw in construction with their newly optimized factory floors.
Yep. Add in the fact that they have $25.1 million in total liquidity to fund their operations. And management has noted that the scheduling delays that plagued the industry last year are finally normalizing.
So projects aren't being canceled, the demand was just deferred?
Exactly.
Yeah.
They are sitting on a massive coiled spring of client demand.
That completely reframes how we should look at that initial $3.3 million net loss from Q1.
Totally.
This isn't just a story of a bad quarter. This is a story of a company actively tearing up its own foundation to build something stronger.
Yeah.
I mean, they're taking the pain of aluminum tariffs and turning it into cross-border manufacturing agility. They are paying millions in reorganization fees to strip out middle management and become a leaner, tech-forward company.
Right.
They are fighting fiercely in court to protect their proprietary software, securing truces with their biggest investors, and quietly building a highly predictable $338 million pipeline.
The core lesson buried in this earnings report is critical for anyone operating in today's economy. Whether you're managing a small team, running a global supply chain, or just trying to understand the market.
Absolutely.
Top-line revenue growth is just a vanity metric if your supply chain can be wiped out by a single tariff.
Yeah.
In the modern business landscape, your biggest asset isn't necessarily what you make. It's your geographic agility. The ability to instantly change where and how you manufacture based on real-time global volatility, that is the ultimate competitive advantage.
Geographic agility over pure cost cutting. I love that.
Yeah.
And it leaves us with a final provocative thought for you to ponder today. DIRTT managed to take what started as a purely defensive panic move, a forced reaction to sudden tariffs, and they engineered it so deeply into their operations that it became a permanent structural advantage over their competitors.
Right. They evolved.
They didn't just survive the obstacle, they made the obstacle their blueprint. So think about your own life or your own career. What temporary defensive pivot have you had to make recently under pressure? Because if you look closely enough at the mechanics of that pivot, it might actually be the exact blueprint you need for your next big competitive advantage.